Hey, everybody. Welcome back to another episode of the Blockware Intelligence Podcast. Today, we have two special guests, both from Blockware Solutions. We've got Joe Burnett and Tanner Davis. Guys, thank you so much for taking the time. It's nice to get some other Blockware people on here with me to jam.
Yeah, thanks for having us. This is my podcast debut, so I'm psyched to be here.
Nice.
Yeah, thanks, Will.
Yeah, absolutely. I guess we could first start with, for anybody who maybe doesn't know, who are both of you guys? How did you get into the space and what are your roles at Blockware? We could start with Tanner first and then Joe.
Yeah, for sure. So I work as an account executive here at Blockware. So, with that, there's really two kind of hats I wear. The first is, educating and bringing in new partners into our ecosystem. So there's a pretty broad range of people from, complete novices all the way up to, I guess OGs, right? So I have to be able to, work around, different education levels and so on and get these people, into our ecosystem and get going with mining. And then on the other hand, I'm also managing our current partners. So with that, it's more providing insights to help with scalability and, just like future investments basically. So at the end of the day, I'm working in general, sales role, account executive, but at the same time, just due to the nature of the industry and what we do, it's a little bit of a mix, as an analyst as well. So a little bit about like what you guys do, but more on, the client facing side.
Joe.
Cool. Yeah. Cool, Tanner. Yeah. So I'm a mining analyst here at Blockware Solutions. So I mainly focus on Bitcoin and Bitcoin mining research. As you probably, many of you guys might be subscribed to the Blockware Intelligence newsletter. I do that. And I also create weekly mining, like educational videos on our YouTube channel. But before Blockware, I was an analyst at Mimesis Capital, which is basically a family office that has adopted the Bitcoin standard. And so we invested in a lot of different early stage Bitcoin companies like Unchained Capital, Foundation Devices, Swan Bitcoin. And when I was there, we did Umbrel. After that, I did technology consulting at EY. I was in their intelligent automation practice, but excited to be in the Bitcoin space now with here at Blockware.
Absolutely. We're happy to have you here, man. Before we get into kind of like the meat and potatoes, Joe, if you want to just kind of give listeners a high level of why Bitcoin, right? Before we even get into why mine Bitcoin, just kind of make the case. Although I think a lot of the listeners probably understand a lot of this, maybe some don't. So, why get involved with Bitcoin? Why is it so important?
Yeah, no, it's a great question. And I feel like I like to answer this question because I think a lot of people are on Twitter or YouTube or wherever, and they may hear like very specific cases for Bitcoin and like why you should buy Bitcoin and why you should hold it. But not all the time do you like have a very clear, like succinct way of like, oh, this is what Bitcoin is. This is why it's valuable. And so kind of on Twitter, I kind of hammer down like a lot of these points, but I'll just quickly kind of run through like why I think Bitcoin is important. So I think, a lot of smart people, when they first hear about Bitcoin, they kind of, think it's a bubble, right? Think it's a bubble or Ponzi scheme or whatever. And I think like a big reason as to why people think that is because like monetary value itself is, kind of dependent on other humans. It's dependent on each other. And if like you're trapped on an island alone, like a monetary good serves no use for you. Like dollars, gold, whatever, it's pretty worthless if you can't trade it with someone else. But just because, Bitcoin's value is, dependent on other humans doesn't necessarily mean like it's like a collective hallucination, or like some people even like say it's like a cult. I think it's important to really understand like why so many people are so passionate about Bitcoin. And I think it's because of Bitcoin's super unique monetary properties. And so it's kind of like a monetary Schelling point where humans are like converging upon it because of its unique monetary properties. And these properties are, immutable scarcity. There's only 21 million Bitcoin, divisibility, portability, and other monetary traits like durability. And I think because of these unique monetary properties, people are converging upon Bitcoin. They're learning that, hey, if I buy this and I hold it, there's no matter how high the price goes, people can't create more of it because there's only going to be 21 million. And so, yeah, I think generally the best way to think about Bitcoin is it's simply the world's best savings technology.
Yeah, I think that's a great high level. Hey, Tanner, before we get into kind of, current events, can we just have you kind of back up and give us an overview of what have been some of the major developments over the last, call it, year or two, but especially there was a lot going on last year. So maybe if someone hasn't been keeping up with what's going on in the mining space, what are some of kind of the key events or developments that have occurred over the last 12 to 24 months?
Yeah, I mean, I would say one of the biggest developments is really just the influx of capital, right? Everybody sees the market. You see, whether it's Riot or Marathon or these smaller miners that are starting to, whether it's reverse merge or SPAC, whatever it may be, public money is starting to flood into these mining firms, somewhat as a way to gain exposure to Bitcoin. If you're a fund that isn't able to buy Bitcoin, so just the general overall adoption and capital inflows have been, a pretty crazy thing to watch over the last, 2 years or so, really since, the crash down to 3,000 with the liquidity crunch in the equities markets and all of that. And then really on the mining side, the biggest thing has been, just the exodus of hash power, right? So last summer, there was a ban in China where a huge chunk of mining was taking place. This, as these miners unplug, the network adjusts. So the difficulty was dropped by 50%, which means if you're in China, you had to unplug, which is bad for them. But if you're a miner elsewhere, all of a sudden your yield jumps dramatically, and you're able to make twice as much Bitcoin as you would normally, assuming the market will remain flat. So that was a pretty crazy event to see go down. And with that, you saw an influx of mining rigs on the market. So it used to be pretty difficult to get hardware at all. There's dramatic lead times across the board. But then all of a sudden, these Chinese miners are, if they can't find a place to put their machines, they'll sell them. And when they're in a crunch for cash, right, they're not willing to barter. They'll just sell it for cheaper than the market dictates for a quick sale. So that was really one of the more unique events that we've seen. And it could happen again, but it's not something that's going to be a annual event. So that was really probably the most impactful thing I've seen personally.
Tanner, what does this kind of mean for Bitcoin long term?
As far as hash rate movement, I mean, the difficulty is just a signal of how much hash rate is on the network, which basically means how many machines are plugged in. As more machines are plugged in, that gives strength to the network, right? And people talk about like 51% attacks, where a group of miners is able to basically rewrite the blockchain. As long as the way that Bitcoin works, its network is growing so much. I mean, its magnitude's larger than everything else, right? That boosts security across the board and makes it an even more attractive asset, especially when you're looking at alternative cryptocurrencies to invest in.
Absolutely. And Joe, I kind of want to pivot this over to you now and just talk about where have you seen some of that hash rate migrate? This is something that you've written about in the newsletter. For a while, there was a lot of what we like to call in the Bitcoin community FUD around the amount of hash rate that was held within the Chinese borders, right? And now with this event, we've started to see some of that hash migrate around the world, as Tanner just noted. So where have you seen the trend of that hash migrating to? And where do you see that kind of playing out over the next year or so?
Yeah, for sure. I think one key thing that this whole China migration has highlighted is that it's very important to deploy your capital into miners that are in a stable political jurisdiction. A jurisdiction where you can be confident that they're not going to ban Bitcoin mining overnight, and you don't have to close up your operations, and you can actually operate your machines. So we basically have had many people become a lot more meticulous about where they're going to deploy capital into mining. Obviously, the US has been probably the main beneficiary of all this capital, especially with public markets being able to raise literally billions of dollars for these Bitcoin miners to deploy capital in the US. But yeah, as far as the hash rate projections for the next year and like where that's going to go, Galaxy Digital actually released a really good report for Bitcoin mining. And, I encourage you to read it. I'm sure we can put it in the show notes for this episode, but they basically projected that the total hash rate of the network would hit about 335 exahash by the end of the year. And from the beginning of the year, that's about, it would be about an 84% increase from like January 1st of this year. And so that's a pretty significant amount of hash rate, amount of new machines coming online. we kind of did our own analysis here at Blockware Intelligence, where we basically compiled all of the hash rate projections from public miners, and then also compiled, just historical trends of how much hash rate is able to grow. And from our analysis, we basically concluded that we would end the year around 300 exahash. So slightly less than Galaxy's projections, but still within the same ballpark. Basically, it kind of means that hash rate is going to grow about 65% according to our projections. And so far, it's crossed our fingers. I mean, it's pretty much right on track, but we'll see. But yeah, I mean, a large amount, like I mentioned, of this future hash rate that's coming online is supposed to be coming from public miners. They're able to leverage, the debt and equity markets that, can raise significant amounts of capital in the US. They're financing $100 million ASIC orders. They're building capital intensive mining infrastructure, and they're really scaling their operations. For example, Riot's expected to bring on about 6 exahash this year. Marathon's expected to bring on about 20.1 exahash. So all of these companies are bringing on a significant amount of hash power, and I kind of expect that to continue.
Hey, Joe, kind of on that note, at the end of 2019, we saw this massive kind of miner capitulation that kind of set the bottom of the bear market. With this access to like external financing, do you think the probability of some type of event very similar to that is lower with this with the current market structure that we have now, or do you think it's just too hard to tell?
It's a good question. I mean, I think you're basically saying, like, is there going to be another minor capitulation event sometime soon?
Yeah.
As far as soon, I don't think so. Just because I think mining is still significantly profitable. I think we still do have, and I can go into this later, but we still do have a lot of old generation machines on the network. So if price really did, get hurt further from here, then yes, like there's going to be, significant, not significant, but maybe 20% of the network is old generation machines. So that those could possibly go away. But yeah, I don't think we'll see anything necessarily like the massive difficulty adjustments downward that we saw after the China mining ban. Like that was pretty crazy. And obviously it wasn't necessarily because of price. It was mainly just because of political jurisdiction rules.
Yeah, that makes a lot of sense. One other kind of like price related question, and this is something that I feel like always gets kind of debated between the Bitcoin community, and this is for either of you guys, because I don't have the answer, is does hash lead price or does price lead hash? Or is it just a very nuanced relationship and it's not, it's kind of like did the chicken lay the egg or that, that whole kind of thing?
Yeah, no, that's a great question. I've tried to think about this for a while, but I think it's complicated, right? I think there's kind of two different prices for Bitcoin. There's a price, or there's lots of prices, I guess, but the main price that we all know of is dollars per Bitcoin. That's just, how much dollars you can buy per Bitcoin. There's rubles, there's yen, there's different, fiat currencies that you quote Bitcoin in. But then there's also terahash per Bitcoin. And this is basically, like the price that miners are paying per Bitcoin. And obviously miners are typically, buying Bitcoin at a discount. So like the terahash may cost, I don't know, 7 cents per kilowatt hour of electricity. And with a new gen machine, you may be able to basically the dollar equivalent of that terahash per Bitcoin might be like $8,000. So you might be able to mine a Bitcoin at $8,000, but that's just because you're buying the terahash, which is from the ASIC, from the miner, and then that's giving you actual Bitcoin. So I think it's complicated. Like I think both kind of work together, I guess. If the price gets too overextended and it becomes extremely profitable to mine, then I think a bunch of capital floods into mining, kind of like what we're seeing and what we've been seeing. And then I think if price, falls, significantly further, it makes more sense to just deploy capital into Bitcoin.
Makes sense. Tanner, I kind of want to pivot it over to you and ask you, what are the difference between the different mining rigs? So someone coming into the space, they probably just see these like funky looking machines, right? And they don't really know what's going on, right? And they all kind of look the same. What is the difference between these different machines? What are kind of, I guess, the pros and cons of each of them? And, why would one use, one machine, for example, versus another? And just kind of walk us through the high level of that.
Yeah. So, when it comes to on the hardware side, there's really two important specs. The first is hash rate. So, like we've been talking about, you want to maximize your hash rate. That's, how much, hash you're putting on the network is, determines your yield. So more hash means more yield. And then the other, important factor is the efficiency. So the way it's measured, for mining rigs is generally watts per terahash. So for each terahash of computing power, how much watts is being used to run the machine. So, in an ideal world, you want to maximize the terahash and you want to minimize your watts per terahash. That gives you the lowest operating cost, but you're still, making the most Bitcoin. So with that, the way the hardware cycles have, worked over the years is as machines improve, that, boost terahash while increasing efficiency or decreasing the amount of watts per terahash. So like right now, there's really two key manufacturers: Bitmain, who produces the AMP miners, the S19s that most people talk about, and then MicroBT, who produces the What's miners. So those are kind of the two big dogs in all this. They make pretty much all the Bitcoin machines that you would hear about people using. And with that, the current generation machines are somewhere in the about 100 terahash range, give or take, and they're in the mid to low 30s as far as watts per terahash goes. So that, like right now, that's about as good as it gets. And now, with Bitmain putting out a new machine, it's set to start shipping at the end of July here. That's the S19 XP. That is 140 terahash. So that's a 40% increase in computing power, which directly impacts your yield. So you have a 40% more Bitcoin, accrued when compared to the current machines. They're also a lot more efficient. So, a general machine, we'll call it, about 30 watts per terahash. The new machines are down to 21. So they're using, on a rough one-to-one basis, they're using about the same amount of power, but yielding 40% more. So it's definitely a significant upgrade. And it'll, our opinion, it's what everyone's going to want to start moving towards, right? Historically, when we saw the S19s first come out in 2020, right around the halving event, people were kind of torn, do I want to invest money into these new machines, or do I want to pick up, sort of the current generation equipment? It's starting to see, pretty favorable pricing, just because, demand always rushes to the new thing. So, I mean, on paper, it made sense potentially to wait for the S19s. And then, we've seen how that played out. And the people who bought S19s made an absolute killing, especially when you're comparing it to, taking an older machine. So, S17, for example, which is, on average, we'll say about, 60 terahash, but uses, closer to 45 watts per terahash. So your operating cost is higher while your yield is lower. So, I mean, it's a no-brainer, but it not everybody wants to, put their money towards the latest and greatest, which is understandable, but historically it's been the best bet. So it'll be interesting to see how it plays out moving forward. But really, we're in kind of a unique spot where, they're still producing what we call like the current machines, but there's new stuff, rolling right around the corner. So I think we're going to start to see a transition, especially as more become available on the market. And with that, we've seen Intel come along too. They're trying to put out their miners. I know they had, their first prototype that was, grossly underperforms what's considered like, standard for new equipment. And then they more recently came out with a new machine that, they've been selling more exclusively. They have some partners. I think Grid is one of their partners, and there's a couple others that are more on par with, the new S19 XPs. But I mean, it's just going to take time, right? They're a new entrant, and, yeah, it's Intel, but at the end of the day, Bitmain and MicroBT have been doing this and kind of have a strangle on the market for Bitcoin miners at this point. So I don't think Intel is going to come in, and instantly just take over everything. It's going to take them, significant amount of time to really gain a lot of traction. So I don't know. I mean, it'll be interesting to see. It's kind of like, you have Apple and Android, and now a third player wants to come in. So
Yeah, no, that's really interesting. And I guess, over the long term, competition is good for the consumer, right? So
yeah, definitely.
Hey Tyler, one thing that you said in a meeting, and I stole it from you and tweeted it out, but didn't give you any credit, was this whole concept that Bitcoin miners are essentially dividend paying assets. So can you, for listeners, expand on what that means?
Yeah. So, when you think about a mining rig, there's two trains of thoughts to, kind of explain it, and they're not mutually exclusive. The first is, the narrative, right? Which is always your dollar cost averaging Bitcoin at a discount, right? You're arbitraging power and getting Bitcoin, and it's not proportional. If you took your operating costs, went on Coinbase and bought Bitcoin, you're going to get significantly less than if you ran that mining rig for a month or whatever time period. So that is the traditional way of looking at things. But when it really comes down to it, the mining rig is a hard asset. It's it's tangible. You can hold in your hands, right? Which is a little different than when you think about traditional Bitcoin. So with that, it has its own value associated. There's a whole secondary market. It's very hard to buy rigs from the manufacturer, and that's why Blockware Solutions exists. So it's a hard asset, and it's a dividend paying asset. It pays you out Bitcoin on a constant stream. It's it varies in how much it'll be, right, depending on difficulty and then with the price of Bitcoin. But the terminal value is, that's the term we use, which is really how much is your rig worth right now? So what we've seen with current generation equipment, so, S19s and the WhatsMiner M30S Plus machines, is it's holding about a 0.95 correlation with the Bitcoin price. So if Bitcoin goes up in value, your machine is going up in value. So, a unique way of looking at your investment over, say a medium term time horizon, 2-3 years, when you're deploying capital towards a new machine, you can buy the machine, run it for a few years. If you're bullish on Bitcoin, which I assume anyone investing in mining probably is, run it for a couple of years. Bitcoin has appreciated in value, and then you can exit those machines, either upgrade or invest elsewhere, whatever you want to do, and you could cash out for more than you paid for the machines, and you effectively mine Bitcoin for free for years. It's rare, like as a trade, to be that great, but we've seen people do it with that. Like I said before, the S19s, when they first came out, people bought them at the time. Rigs were not as expensive as they are now, but Bitcoin was cheaper. And I mean, it makes sense. If the yield is low, why would you pay as much for the machine? But at the same time, if it generates you more money, whoever's selling it is going to charge you more. It's just supply and demand. So people bought S19s, let's say, for around $2,500. They mined for even a year, rode that into May, April 2021, when Bitcoin was skyrocketing, sold their machines for $15,000, and then they also generated Bitcoin over that whole period. So it's like the best trade you can make in the world. So a lot of people kind of forget, like, the mining rig isn't just a sunk cost. There's always people buying machines. And yeah, the correlation is going to fall over time. It's just, useful life gets extended out. And what's just amazing about the mining, ecosystem is it's just a trickle down effect, right? As machines become, kind of outdated, less efficient, it just flows to the people with the cheapest power. That's why you see like S9s, for example. Those are, 6 years old, not efficient whatsoever, 11, 12 terahash, and they're still making up like 25% of the global hash rate. So all that stuff just flows downstream to places like, Venezuela, where their power cost is just, rock bottom. So there's always a market. It's trying to catch that edge where you ran your machines, you've made a great, a nice chunk of Bitcoin, you've held onto that the whole time, you're catching upside appreciation, and then, you can sell your machines. So that's what we mean when we talk about, dividend paying hard asset, which is, it's not exclusive. You're still dollar cost averaging Bitcoin. It doesn't change anything. It's just, a unique way of looking at it. And it's something that, I guess anecdotally, I see all the time on my end, talking with our partners and, prospects, like, especially for people that have long time horizons and, capital to spend, they would rather take, this 6-month lead time, but they're getting a better machine that's going to last longer and has a highly, likelihood of being worth a lot more money than you paid. So, I mean, it's a no-brainer if you really think about it.
Yeah, no, man, that was super well said. And I really like that phrase. That I think it makes a lot of sense. It's very obvious, but it's like, it's very clean. It's very, very well said. Hey, Joe, want to kind of pivot it over to you. So one thing that you've talked about is like, is mining rigs being like safe haven assets, in particular, like the newer generation ones. Do you see this as the case, and why?
Yeah, it's such a good question. I actually am publishing a new research report. It'll be summary will be in the newsletter of Blockware Intelligence, but we'll also publish the full report on blockwaresolutions.com. But basically, it's showcasing the idea of that new generation machines are actually, safe haven Bitcoin assets. Even though you might think that and you'd be like, that's insane. Like, how could you possibly say that? But the way the Bitcoin network is set up and the way the difficulty adjustment is set up, they actually do behave as short-term safe haven assets. So I'm sure everyone here knows, but Bitcoin is a highly volatile asset. And that's kind of what scares away a lot of people from deploying significant amounts of capital into Bitcoin. One, they don't understand it, but two, the volatility is just kind of scares them away. The new generation machine that Tanner was just talking about, that's going to be out very soon, the S19 XP. If you're running it today, it would currently have an operating margin north of 80%, meaning, you're paying $2 for electricity and you're getting $10 worth of Bitcoin. Like that's pretty insane. So in the report that I'm releasing, that's going to showcase this a lot in a lot more detail. We basically use CoinShares research to break down the network based off what percentage of hash rate corresponds to like which machine. So like which machines or what percentage of hash rate are S9s, what percentage is S17, generation machines, what percentage is S19. And currently about 20% of the network, according to the CoinShares research, is S9s or S9 related machines. And so using also old Blockware solutions research, we can kind of overlay those machines with where they are in the electricity grid. So like how much are they paying for electricity? Typically the S9s are going to, like Tanner said, go towards more cheaper electricity sources because that's where they're still extremely profitable. And then the newer generation machines are just going to rush to whatever hosting capacity is available. And they're going to be willing to pay for more of like the hosting type rates because, it makes the most sense to do that. And so with the stress test, we basically said, all right, if Bitcoin falls to $19,000 and it sustains there for, significant amount of time, we estimated that about 11.5% of the current hash rate would shut off. This would pretty much be entirely S9s that are operating, into, somewhat decent electricity rates. So they would turn off and difficulty would adjust downward. But even after, this crash occurred, significant price crash, that's over, I guess if Bitcoin's at $40,000, it's over 50% price crash. But the operating margin of the S19 XP would actually still be north of 50%. So when when price falls enough, difficulty starts falling. When difficulty starts falling, the new generation machines are actually going to start earning even more Bitcoin than they were before. And so not only do you start getting more Bitcoin, but your Bitcoin break-even price, meaning like what does the price of Bitcoin need to be for you to make, money, for your machine to be profitable, actually starts going down if the price goes down enough to where other machines, have to turn off. And if you buy the newest generation machine, the safe haven asset, you're kind of insulated against drawdowns because if it does draw down, then all of these old machines, which is literally everyone else, must turn off their machines before you do, unless they want to operate unprofitably, which I don't think anyone would really want to do.
Yeah, for sure.
Just to go off that, that's kind of a common thing, people always are concerned about is, I'm worried, Bitcoin price is super volatile. I don't know if I'll be able to remain profitable. If you have the best machines on the market and you don't have, outrageous energy rates, no matter what happens with the price, you are the best positioned person in the market, right? So it's always, a waiting game. People want to try and buy in at the perfect price or are nervous with, whatever macro events or just, general volatility. Like if you really think about it, you're hedging your downside because if the market falls, you just make more Bitcoin. So I think that was super well said and something, it kind of goes over a lot of people's heads.
Yeah, no, for sure. Tanner, while you're talking here, I want to ask you, like, what are some of the, I guess, trends that you're seeing anecdotally with our clients? You're dealing with our clients on a day-to-day basis. You get your finger on the pulse with what's going on from, the consumer side of things. So what are some of those trends that you're seeing? Is there anything that's really stuck out to you over the last year or so?
Yeah, I mean, we've already hammered it in, but the push for XPs is already begun, and it's just going to keep growing, especially as the lead time gets shut down. For new entrants, it's hard to stomach, right? You're going to have to wait quite a while, and everyone's antsy. They want to start mining instantly. Whether it's a better idea to wait or not. So for the most savvy clients, if they have capital to spend, they're going to put it towards XPs. It makes logical sense from a the dividend paying hard asset point of view. It makes more sense from the price volatility protection point of view. It's just the most logical trade you can make, and it's hard psychologically, because you're making an investment and you got to wait, which nobody likes to wait, of course, but it's just what I've seen the most. And then with that is really just an influx of people, either one with access to machines and nowhere to put them, or trying to move machines as of recent, either from Kazakhstan and Russia. Those were two pretty key spots besides the US where miners migrated to from China last summer. So Kazakhstan said global issues for the last, let's say, 6 months, internet shutdowns, so on. Russia's on pace to be a global pariah, pretty much already are. So it's just, if you're an investor, you want to protect your investment. It's illogical to, even if, US power costs are a cent higher than it is overseas, like, you'd rather spend the money to know that your investment's protected in the US. There's no recourse if, the Russian government takes your machines. You can't sue the Russian government. You're out of luck. So, with that, I would say hosting space is going to continue to become, the biggest sort of, crux for mining right now. It's super hard to find, valuable hosting space that can be executed on, that, has room to grow and so on. So, I mean, that's really where we've shined, because we've been working on this since before the Chinese exodus, and we were a little bit ahead of the curve. But even a year ago, it was the hardest part of getting into mining was getting rigs. There was unlimited demand for rigs, and people still had all sorts of infrastructure in place, and now it's just a huge weight on the infrastructure side, and it's hard to do. A lot of people think you just slap up 4 walls and plug the machines in, but there's so much that goes into building this all out. And with that, power assets are all in a huge supply chain crunch. There's lead times for everything in the world at this point, so it's hard to do. People are always trying to build their own sites and so on, and it's awesome if you can do it, but it's just hard. So if you can find a hosting provider, it's a no-brainer, and you can just spend more money on miners versus purchasing land and power assets and so on. It's just a complete no-brainer on our end.
Yeah, that makes a lot of sense. Joe, as we kind of move to wrapping it up, one of the main topics I wanted to hit on was just like zooming out and giving this very like broad, quote unquote, macro view of Bitcoin mining over, call it, the next 5 or 10 years. Why are you personally bullish on Bitcoin mining this decade, and what are some of the trends that you kind of foresee playing out moving forward?
Yeah. So I published a pretty good research report on blockwaresolutions.com, and it kind of talked about the 2020s being like this golden age for Bitcoin mining. And I think the reason for that is that price is kind of at a tipping point, right? Like, I think Bitcoin is kind of on the cusp of like actual mass adoption, and like kind of like for the reasons I laid out at the very beginning of this podcast. It's immutably scarce. Like, you can't change that. So I think more and more people are starting to learn that. They're feeling more comfortable that like, hey, like Bitcoin doesn't die, like it keeps existing, even though it may crash 80%, every few years. It keeps coming back, and not only does it come back, it comes back magnitudes larger. And so I think like this idea that price could actually grow faster than hash rate, or at least compared to historically, like historically hash rate grew extremely fast. Now hash rate is still growing really fast, but it's not growing as fast, and price is still growing really fast on like a broader, longer term time frame. And the reason hash rate is not growing as fast as it once was is because ASICs are commoditizing. What does that mean? So basically it means that ASICs, the ASICs like the XP, it is more efficient, and it's, like Tanner says, about 40% more efficient, but it's not like compared to the first ASIC compared to the second ASIC that was ever created. Like that was a magnitude change in efficiency. So immediately those old ASICs, became extinct, unusable, and these new ASIC kind of pushed them out really fast. But now that these ASICs are kind of commoditizing, and the ASIC that gets developed after the XP, it won't be like exponentially better than the XP. Like it'll still be very competitive. You'll be able to compete. It'll be slightly better, but you still it's not going to push out the XP immediately. So these new generation machines that exist today, they're going to be able to last for significantly longer than they have in the past. And if price, continues to do like what it's done in the past, where it goes up like actual magnitudes or multiples, then these miners are going to be, sitting on gold mines. Basically, these machines will just be spitting off massive cash flows, and they could actually last for a significant amount of time.
And going off that, something that is also, not commonly considered is really just the size of the network. The law of large numbers is in play, right? Adding 1 to 1 is 100% increase. Adding, 1 to trillions is a much marginally smaller increase. As Bitcoin hash rate grows, more machines getting plugged in has a diminishing effect on difficulty. So, that's just another thing to consider. As the network keeps growing, it becomes harder to sustain these large jumps. If Bitcoin goes up 100% tomorrow, it is literally impossible for difficulty to follow 100% in the next, difficulty jump, with one, the amount of machines required to do that, and two, just the actual infrastructure to make it happen.
That's really well put. One of the main things I wanted to hit on as well was just the kind of ESG FUD. That's been a huge narrative that's gotten pushed to kind of, FUD around Bitcoin and in specific, obviously Bitcoin mining. So Joe, do you want to kind of hit on that? And what do you kind of have to say to refute this?
Yeah. So I think Bitcoin mining, like we're saying, you have the new gen machines that are going to be plugged in, wherever at top tier, highly secure hosting facilities. But then you have the old gen machines that are still useful. They still create terahashes, but they have very low efficiency. So you can only operate them in special areas. Basically, those machines move towards areas of the world where there's a bunch of wasted energy. For example, natural gas people, they occasionally, if they can't sell their natural gas or put it in a pipeline, they have to flare it. So they're literally just wasting excess energy. If Bitcoin miners, and this is already happening, like ConocoPhillips, one of the largest oil and gas companies in the US, just announced that they're working with someone to do this in North Dakota, I believe. They can partner with someone, put the ASICs next to the natural gas site where they were flaring it, and it was just actually bad for the environment. Now they plug in those miners instead. They can actually make Bitcoin. They can buy these miners for cheap because no one really wants the S9 anymore. They can make more money. And then all of a sudden, the flaring is eliminated. So you actually can use wasted energy to create, more Bitcoin. In addition to that, Bitcoin actually helps balance energy grids. So for example, if you set up a huge mining farm in Texas, you can negotiate a deal with ERCOT, which is basically their grid, and say, all right, we want this, facility to have power, 98% of the time. And whenever there's a strain on the grid, for example, maybe the grid is powered by solar partially, and it's in the middle of winter and there hasn't been sunny for like 5 days. The grid is strained. Everyone's running their heaters. Now ERCOT can just say, all right, we'll turn you guys off this huge Bitcoin mine. You guys cannot run for an hour or so, or however long they need. And we can actually source that power and send it to consumers or other businesses that actually really need it. And so it kind of increases the reliability of these grids and adds more like redundancy, and even incentivizes more power development, incentivizes more nuclear plants, more solar, more wind. So it's kind of like a solution, I guess, to ESG, in my opinion, rather than a problem.
Miners are the craftiest bunch, right? They want the cheapest power, which is, either renewable or, wasted energy elsewhere. So regardless of if the, miners actually cares about ESG or not, they're supporting it because they want to boost their margins.
Yeah, that's really well said. Hey, Tanner, we really kind of laid out throughout this whole podcast, all these kinds of current events going on with mining, but as well, what mining is, how does it work? What are the specs on different machines and what are kind of the different aspects that go into being a Bitcoin miner? If listeners are interested, why mine with Blockware? I think maybe not many people listening, they've listened to the podcast, maybe they don't know fully what we do per se, but can you kind of just run listeners through, what do we do and why is it more advantageous for them to look at mining with us versus some of the other market participants?
Yeah. So what we do is vertically integrated mining. So we're able to source and sell you the mining rigs that we've been talking about. We're able to put these mining rigs in our hosting facilities so we can run them. We have at industrial power rates to maximize your margins, right? You're getting the lowest operating costs while maximizing your hash rate. And then on top of that, we operate a mining pool. It's all domiciled in the US. So we're able to take care of the technical backend, get your miners, running and then on the pool. So you're able to remotely, you can monitor performance and revenue statistics, and then you just get your revenue pushed out to you every 24 hours. So, at the highest level, you're able to place down, a capital investment. We basically take care of all the, intermediate steps, and then you're generating returns on the investment. It knocks down all of the barriers to entry and makes it easy for, if you're a hedge fund, you're not going to go out and set up a mining facility. But if you want exposure to Bitcoin mining, a company like Blockware makes it super easy to do. And then, on top of that, with our Blockware intelligence arm, right, we're able to provide, unique insights into the market more so than just sell you stuff, right? So we're combining, analytics in our intelligence arm with, the vertically integrated, mining stack that we provide for, a true holistic solution here. So we're able to provide support, whether it's on the hardware, hosting, pool, any possible thing you could need, we're able to do. And then with that, we're also providing, actual insight to our client base to help them grow, right? It's good for everybody. We want everybody to win and grow. And by combining both of these, it makes it a lot easier for them to do so.
And Tanner, where can people go to get in contact with us or you specifically?
Yeah, so you can always reach out through our website, blockwaresolutions.com, or you can shoot me a note personally. My email is just tanner@blockwaresolutions.com, or reach out to sales@blockwaresolutions.com. We're easy to get in touch with. Shoot us a note on Twitter. Follow our Telegram channels. We'll put all the links in the description on the video, all that. But we're easy to get in touch with, and want to help everybody.
Gentlemen, it's been an absolute pleasure. You guys crushed it. I think we touched on pretty much everything that we all had in mind and then some. So before wrapping up, I do want to give you guys an opportunity to plug yourselves in if you want to plug in your Twitter or if you have any kind of final thoughts to wrap up. So we'll start with Tanner and then you, Joe.
Yeah, I mean, shoot me a note, tanner@blockwaresolutions.com, like I said, or my Twitter is Tanner Davis 315. So yeah, give me a follow if you want, but I'm easy to find. So just track me down.
Yeah, and I'm Joe Burnett on Twitter. My handle is @III Capital. I was once 3 Capital on Twitter. But yeah, if you want to email me, feel free to email me. I'm joe@blockwaresolutions.com.
Awesome. Thank you guys so much for the time. This was great.
Yeah, thanks, Will.
Thanks for having us.
Talk soon. Bye.
See ya.